Welcome to Wednesday Web Chat. This is Carl Lewis, your host from Vision 33. Our guest today is Maria Tringali from Avalara. Maria, welcome.
Thank you, Carl. I am delighted to be here. It is always fun to chat with you. I really appreciate you having me. We are going to talk about the very exciting subject of sales tax compliance. We've been delighted to partner with Vision 33. I know I've been working with the group there for the 7 years I've been here at Avalara, and one of the topics near and dear to my heart, which is tax compliance for those of us who don't actually charge a lot of sales tax. So we're going to talk a little bit about that today. So we know, I'm well aware that distributors, manufacturers generally don't have a lot of retail sales tax. However, there's still a tax compliance responsibility to your business. So let's dive into that, Carl. Also, we'll have time for questions at the end. So anyone that's on the line live, if you have some questions, go ahead and chat those in and we can always answer them towards the end. So a little introduction of myself. So I've been with Avalara for 7 years now, past that 7-year mark. And I work with our customers and our sales team and our prospective customers, as well as our internal product teams, again, on the nuances of tax compliance for businesses that don't charge a lot of tax. I provide training and education. I work with partners like Vision 33 and making sure that we stay current and up to date with all the responsibilities that businesses have that don't charge a lot of tax and are collecting exemption certificates, still have to file returns, still have to register and that sort of thing. So delighted again to be here today. Let's dive into our agenda. So we're going to talk today, this is actually a two-part series. This is part one. We're going to talk today about Nexus. What actually is Nexus? How can you trigger it? A little bit about everyone's favorite subject, drop shipping, and also product and service taxability and changes that have been happening in the marketplace, as well as exemption certificates. And of course, again, leave some time for questions at the end. So jot them down, put them in the Q&A, and I'll definitely answer them live at the end. So let's talk about Nexus first. So Nexus is the responsibility to report into a state of your revenue and any applicable sales tax, collect tax, or collect exemption certificates in a state based on the laws that they have come up with, that they determine requires you to register in that state. So what that means is it could be physical nexus, so we'll talk a little about that, or it could be now economic nexus. So it is the responsibility to register, collect, and remit, or at least report, even if you're not collecting tax, to that state. So everyone has this now. It used to be fairly simple for manufacturers and distributors, but it's definitely gotten more complex over the past 3 years. So let's dive into physical nexus. So this is what we have traditionally known. So physical presence, most people know this, but just as a recap, common physical triggers are employees in the state, even if that employee is not actually selling something. I get this question all the time. If I go into, say, Illinois, and I do a user group for SAP B1 users, I'm there on behalf of Avalara. I am talking to users of SAP B1 about tax compliance. Nobody's buying anything from me, but I am still establishing Nexus for Avalara in that state. The state of Illinois would consider me doing business in that state just by attending that user group, even though no money actually changed hands when I'm there. Very same with trade shows. If we attend, and Avalara attends a lot of them, you've probably seen us there. If we attend trade shows across the country, when I attend or my friend Megan attends, that is establishing physical nexus for Avalara in that state. Even though no money changes hands at that trade show booth, we are considered doing business in that state. And the state wants a cut of revenue because we are marketing to, we are trying to do business with constituents in their state. So this can be, it's not necessarily just brick and mortar stores. So that's a very misunderstood, I think, nuance. Now, yes, every state does have their own rules and laws, and states like Florida and Nevada, who do a lot of trade shows, also allow some temporary nexus applications and those sorts of things. I'm not going to get into all that today. There are some nuances. But in general, if you have traveling salespeople and attending trade shows, you've established physical nexus in that state. And then, of course, there's property, and this one gets confusing as well. if you have a brick and mortar store, or you have a warehouse where you store things across the country. Avalara has offices. We sell software. We're not selling anything physical, but we have offices in several states. We have offices in Wisconsin, in Washington, in North Carolina, in Texas. So we have a physical presence. We have to register for sales and use tax in those states. If we were selling something with inventory and we were also storing inventory in different states, that would be physical presence. So let's translate that into our online presence world. So if I have my inventory, if I'm selling fulfillment by Amazon and I'm storing my inventory in an Amazon warehouse, and as far as I know, I think there's only maybe 4 or 5 states left that Amazon doesn't have warehouses in where FBA sellers can store their inventory. That inventory is still yours while it's sitting in the Amazon warehouse. You are definitely triggering physical nexus by having your inventory sitting in somebody else's warehouse, whether it's Amazon or Walmart or whoever. If you own the inventory and it's sitting in somebody else's warehouse, that can also trigger nexus. So lots of things to think about these days about physical nexus. It's not just having an office. And then we add into the complexity the economic nexus. So economic nexus has come into play because the states realized that businesses are basically shipping product in, they have a physical presence in another state and they're paying taxes there, but they're shipping product into their state. So South Dakota, of course, started this. So economic nexus, 3 years ago now, in June of 2016, 2017, I can't remember, 3 years ago, the state of South Dakota said, hey, we don't have a lot of shopping malls in our state, but everyone's shipping goods into our state, and we want a cut of that revenue because our constituents are buying from these businesses that are out of state, but they're being used in our state, so we want a cut of that revenue. So this went all the way to the Supreme Court, and the Supreme Court decided, yeah, hey, states can actually require that businesses pay them tax if they're sending a certain amount of revenue and invoices into somebody else's state. So this kind of went wildfire. So now today, almost all of the 46 jurisdictions with sales tax also have an economic nexus law in place. And these keep changing. So here's a couple examples. So and they're different because in the United States, we allow all of our states to make their own laws. Each state has definitely made their own law. So here's a couple of examples. So California's threshold is $500,000. If you're selling more than $500,000 into the state of California, regardless of how it gets there, you don't need to be an internet seller. This is another big misconception. People think these are internet laws. They're not actually internet laws. It's no matter how you are sending those products into that state. If you exceed $500,000 in sales in California, you need to register and start collecting and remitting either sales tax or exemption certificates in that state. They, however, do not include services. So that $500,000 can be sans services. Michigan thought of it a little bit differently. So they said tangible personal property going into their state that exceeds $100,000 or 200 transactions. So even if you're selling, say, supplements that sell at $10 a bottle, but you had more than 200 invoices go into California and it's nowhere near $100,000 in revenue, you still have to register and start collecting and reporting in the state of Michigan. They, however, say exempt sales are included in the threshold, where some states say they aren't. So you have to be careful, those of us in manufacturing and distributing, you have to be careful of whether that state actually counts exempt sales or doesn't count exempt sales towards those thresholds. And then Maine said tangible property includes electronically transferred property. So they're including not just physical property, but also things like software as a service is included in that $100,000 or 200 transactions. So each state has made up its own rules. So you can see here, here's another example. So it's all the way across the country now that we have to understand these nexus laws and understand where our business has actually established a presence given all of these new laws. And this is just a quick shot of the difference between here's how it used to be with economic nexus laws. There were just a few states that had some economic nexus laws. Once those laws were passed, almost all states have jumped on the bandwagon and now have some sort of economic nexus laws. So before I move on to our next subject, which is drop shipping, I'm just going to say I'm sending you on a trip to the doctor today. If your business has not done a sales tax risk assessment or a nexus study with a company like Avalara, we partner with SAP B1 or with a CPA firm that has a SALT practice, a state and local tax practice, not a local or regional firm, but a practice that actually has a national, state and local use tax presence because they understand all states. Please promise me you will go and do that. It is very important. I don't want our partners to be in the state of risk where a state can come in and audit you and you say, I didn't know that these laws existed, because we know that doesn't pass. And yes, these are actual laws. The states pass laws, and it's our duty as businesses to adhere to those laws. These aren't suggestions. And yes, even if all of your sales are exempt into those states, say you're selling all to distributors and everything's exempt because they're reselling it, you still have to be cognizant of these laws and whether or not that state counts exempt sales towards those thresholds and register in those states. Even if you may not owe them any money because you've collected all the exemption certificates diligently, you still have to report in at minimum at the end of the year on your business practices to them in order to abide by these laws. So yes, you do register, but it should be relatively painless. You only have to file and report in once a year. But make sure you have partnered with either Avalara or a CPA practice that has a SALT practice to understand where your business has established, and make sure you're also monitoring that moving forward, as these things actually do change over time. States are adjusting the threshold, they're adjusting their rules. As we come out of the pandemic, states realize they need more revenue, so they are making some tweaks to these. So do it once, but also do it on an ongoing basis. So let's get off of that soapbox, Carl, and let's move on a little bit to drop shipping. I know a lot of you probably do drop shipping out there. So you probably know I call drop shipping, that you can't see me on camera today, but I call drop shipping the triangle. Somebody in that triangle is holding the hot potato and has to actually pay the tax. It might be the end consumer, the customer. It might be the seller, the retailer who's actually selling it to the customer is remitting the tax, or it might be the manufacturer. I find I've been talking with manufacturers and distributors for 7 years now that it's all very different. There is no one consistent way to manage drop shipping. Some big suppliers say, hey, we're not doing it. If you want to work with us and be our distributor, you've got to go either remit the tax or collect it from the customers. Other people are they want to be the end seller. They want the invoice to come from them. So the manufacturer might be remitting the tax, collecting it from the customer and remitting it, and the distributor is just a middleman that's actually just doing the transfer of goods. It can go any which way. So the challenge is understanding who in the triangle is remitting it and where that business, where is that product going, and where does that business that's actually selling the item have nexus. So I have a lot of businesses come to me that say, hey, we haven't had to register in states before, but now our vendor, say Home Depot, wants us to, we're distributing things for them, or a manufacturer wants us to actually go ahead and register. I mean, they want us to go ahead and collect and remit the sales tax from the end user. They don't want to do it anymore. And so that's forcing me, the distributor, to actually go and register because they have nexus. Therefore, I have to, when I'm shipping items into that state, therefore I have to collect and remit. And the only way I can do that is by registering. So you can see in my example here, if I have a manufacturer in California that ships to a customer in another state, then the retailer has to pay the manufacturer tax. And again, this is, like I said, this is the triangle, this is the hot potato. So whichever way you have organized this with your business partners, somebody has to remit it for the state where the product is going. There are also really great tools. There's tax research tools. Avalara has a fantastic tax research tool I just did a training on this for our sales team. I have this great research tool now that's new. You probably haven't heard of it before, where you can actually go and look up the drop shipping rules as well. So it has a whole section on drop shipping. So if you are a drop shipper or you're involved in drop shipping, this tool could be a fantastic resource for you to understand what the drop shipping laws are and how to orchestrate that best with your partners so that you all remain compliant and the state gets the revenue that they're due and nobody's at risk of having to pay something that they didn't expect to pay in an audit. I will also say that automation can definitely help this, but you also have to work with your partners to understand who in the triangle is actually going to be collecting and remitting. And sometimes people don't want to do that. So the dropship transactions are usually around the ability of the original seller to accept the resale certificate. So this is where our resale certificates come in as well. So the person that's selling it and is also on the hook for collecting and remitting it also would be the one that would be collecting the exemption certificates if they actually apply. And of course, that it depends on where the goods originated and where the goods are being delivered. So there are nuances, such as some states don't honor the reseller status of the out-of-state reseller, and some do. So California, again, they're so much fun. They have their own rules. So that tax research application that I mentioned can really help you understand what these laws are and how they apply to your business. It's complex out there, guys. Get some help. Don't try to make this stuff up. Try to be compliant and use tools. There are tools and partners that can help you, and we're delighted to help you with things like this. It's not easy stuff. So then I also wanted to talk today, moving on to taxability changes. And the reason why I want to talk about this is because I'm sure that most of you listening have done something different over the past year or 2 years where you are changing your online presence. You might be adding B2C that you've never had before. Some products, aftermarket products, something going direct to consumer, not to compete too much with your distributors, but you may have added that. You may be adding the ability for your business to business customers to buy from you in an online presence. Almost everybody I'm talking to has new offerings and new online presence. And what that means is we've got taxability, potentially product taxes that we've never had before. These are new challenges that we've had. And so it's important that your business understand that you also need to keep up with taxability changes. What are the rules? What are the custom tax rules? What do I sell that might have varying taxability? I speak to a lot of businesses that tell me, well, that's not taxable. And they're saying that because they're familiar with their home state rules. They're not familiar with the rules out of their home state. That service might very well be taxable in the state next door or the state across the country. So it's important as our Nexus footprint expands that we also understand the taxability ramifications. Where is it that we need to charge tax? And that takes me back to our tax research product that we were talking about, especially if you're in a large equipment business or you do bids. I was just on the phone this morning with this lady, Bonnie, who works for a company that installs commercial kitchens. And they do very large bids. So they bid on a whole project where someone's creating a commercial kitchen, say for a hotel or a hotel chain. So they have estimators on staff that have to go do this research to figure out what is taxable and not taxable for that project that the salespeople are bidding on, and make sure that the sales tax is included in that bid appropriately. Installation might be taxable in some states. It might not be taxable in other states. They need to understand that so that their bid is accurate to help them win the bid and their invoicing is accurate later. So tax research can really help you understand as you move into new states and need to understand these laws for drop shipping, these laws for installation and services. Having a research tool at your fingertips to actually look this stuff up. I call it kind of a Google and Wikipedia for understanding tax. It's a Google, so it consolidates everything you might be looking for. You could just type in a product or service and it tells you how it's taxed. And it's also a Wikipedia because researchers have actually looked at the state's statutes, interpreted them, and the database literally tells you yes or no, this product or service is taxable or not taxable. So this has been very, very popular with those who have an expanding Nexus footprint because they just really don't understand how things are taxed. You're probably familiar with AvaTax. You've probably heard us talk before. AvaTax, our tax engine, will actually connect with SAP One and do the tax calculation on invoices. But I encourage you to think of all the other times that you need to understand your product and service taxability. And that's bids. That's when a customer asks you questions. That's when you're doing a very large invoice and you might be doing project-based billing or process-based billing. There are times when you're not just creating a repeatable invoice that you do need to actually understand, or maybe new offerings. Maybe you're taking something new to market. We need to understand how that's taxed. We've got to understand this more than ever, more than we have in the past. And then the last subject today is exemption certificates, near and dear to my heart. I've been working with resellers, manufacturers, distributors the whole time that I've been with Avalara. So you probably know that exemption certificates are sort of that get out of jail free card. They are that document that allows you as the seller to not charge tax on your buyer's order. When you register in a state, that state is going to consider everything that you sell to be taxable, sans you having the documentation, aka an exemption certificate, to exempt that business from paying tax on that order. And you, the seller, have the burden of proof of making sure that that document is valid and on file at the time of sale. And this can be challenging. And I know that we all collect them, but we may not be collecting the form. And you can tell by my pictures there that every state has different rules and every state has different forms and different forms for different reasons as well. There can be blanket certificates and there can be individual certificates. So it's really important that we get these accurate. And I also want to talk about the fact that there's a customer-based exemption, and that's what I've been just talking about, my middle section there. So the customer can be exempt, but also products and services can be exempt, as I referred to earlier. There's some, you need to understand the taxability because services or installation might not be taxed, or there are partial exemptions. Then of course your customer can be a religious organization or a government organization that might be exempt. So all the word exemption is tossed around quite a bit in the sales and use tax world in different ways. So products might be exempt, businesses might be exempt by nature, or the business might be exempt by nature of how they're going to use that product later. They're going to resell it. So lots of things going around that term exemption. So your business needs to make sure you understand how each of these apply to your business and think about how automation or partners can help you get this right and not put so much of a burden on your frontline employees trying to guess this or go to Google or do one-off changes. There's a lot going on in tax compliance these days. So, and those forms, as we collect them, those exemption certificate forms, there's a lot of requirements on them. We expect our frontline employees to understand and be tax experts, and I guarantee you they're not. I've been doing this for years, and I am not. I don't know what the resale certificate looks like in the state of Missouri. I don't know how I could expect my frontline employees to actually know what forms need to be collected and where and why, and is it the right form? There's a lot of data that they really should be validating. Is the name and address of the buyer and seller actually accurate? Is the tax registration number an accurate number? Is it valid? What is going to be sold? What type of exemption? Is this guy a manufacturer, a reseller, R&D? What is the signature right? Is that the proper representative? Is it signed and dated? So auditors can look for any of these things and more. There's many other pieces of data that can be on an exemption certificate. I think I heard one of our partners say there's something like 16,000 potential pieces of data that can be on an exemption form across our country. So there's a lot of requirements for these forms that an auditor can trip you up on and make you pay the tax on an order that you didn't collect on because something wasn't accurate. And we really shouldn't be depending on our frontline employees to know this. We should be, as our Nexus footprint, back to Nexus, as our Nexus footprint expands, we want to make sure that we've had a process in place to make their lives a little bit easier. So, Carl, on that, our 3 takeaways here are: manage your Nexus, understand Nexus, understand where your company has its Nexus footprint now, given all of these new laws and changes, and monitor that moving forward. And if that does happen, if you have to register in new states, make sure that you understand your product and service taxability using a research tool, using automation like Avalara or Avatax. Make sure that your business understands how your products and services are taxed outside of your home state, and make sure that you've got a good handle on those exemption certificates, and that your customer experience is really easy, that you make it really easy for your customers who want to be exempt to submit this documentation and get their orders right away. B2B folks want to be fast, quick, they're in a hurry, they got to get things onto their customers